Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. It seems every day there are headlines about private markets. There have been comparisons to cockroaches, thoughts of a financial crisis to the private markets, particularly private credit. Yet they remain on the top of mind for financial advisors who are working on building diversified investment portfolios. I have on an industry expert who's going to share his insights into the world of private markets and help us make sense of it all. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I am very honored and excited to welcome back Andrew Krei. Andrew is this Co-CIO at Crescent Grove Advisors. Andrew, thank you so much for coming on the show again. You were on the first time. It was a fantastic conversation. So I know this conversation is going to be good too. I'm glad I didn't scare you away after that first one and you wanted to come back. Can you please tell us a little bit more about yourself and Crescent Grove Advisors?
Yeah, first off, thanks for having me back. No, it's my pleasure to be here, and I'm looking forward to the conversation as well. Yeah, Crescent Grove Advisors, we're a 5 billion plus AUM RIA based out of the Chicago area. We've got offices in Chicago, Milwaukee, and Atlanta. We really function like a multifamily office. So we're full service in terms of not just offering investment services for our clients, but also offering tax and trust and estate and philanthropic planning, comp and benefits, consulting, those sorts of things. Also, a lot of what we do is investments, though, and we spend a ton of time on private markets, alternative asset classes, broadly speaking. So certainly apropos the conversation that we're going to have here today, I serve as co-chief investment officer, work on a team of 6 that really covers our investment platform, which runs the gamut from everything public markets all the way through, again, these sort of private market strategies, the most esoteric stuff through the most vanilla stuff.
Yeah. Andrew, I don't know if there's anything vanilla in the private market side.
Yeah, I think that's fair. Although I'm sure we'll talk about this, but as this whole wave of retail adoption occurs and we get more kind of the evergreen type strategies, the things that start to mimic the more traditional financial products, I think I wouldn't call them vanilla, certainly, but I think they start to look and feel a little more familiar than they have in the past, perhaps.
Yeah. And you know what, Andrew, I'm glad you brought that up and we will touch on it. That's a good thing, right? Because as you get to the retail side, financial advisors, if you can add a ticker to an investment product, the easier it is to gain access to it, to understand it, I believe. So that innovation in products is, I think, very important. And we'll talk about that shortly. But
no doubt.
Private investments have captured headlines recently, like I said. There remains concerns about the health of private investments, particularly on the private credit side, like I said. Cockroaches, concerns about a financial crisis. What is your take on the current landscape of private markets, and particularly the private credit side?
Yeah, if you want to start with private credit, to your point, ton of headlines around the risk that may be embedded in some of these structures, some of these newer vehicles. I think what we would point to as much as anything is just the magnitude of flows into particularly the upper end of the private credit ecosystem, right? So the larger players, the larger platforms that have done such a great job in terms of their sales and marketing efforts and their product efforts to be able to grow AUM substantially. I think alongside that, if you apply a larger quantum of capital towards a pretty similar opportunity set from what you saw 3, 5, 7 years ago, we wouldn't argue that the opportunity set has radically changed over that period of time. Then it stands to reason that you probably compress returns a little bit, just the sort of supply-demand dynamic occurring there. And if you want to achieve the same rate of return, then you probably have to stretch a little bit for risk. So if we take that as the broad premise and assumption under which we're operating here, again, at the upper end of the market, then I think you could understandably have some concern around the level of risk that's being taken in these portfolios. Now, we don't feel like this is systemic risk. We don't feel like this is something that's going to absolutely corrupt the economy or tip us into recession, something along those lines. But I think, again, you see the evolution of these markets, and every now and again, you would expect some blips as you've seen that the flows and the assets being garnered by these, again, mega platforms. And we can talk a little bit about the bifurcation of the market, I think, as well within private credit, but let me leave it there for now.
No, that's fantastic. And So based on the answer, it sounds like maybe you think some of the concerns are a little overdone, but it's easy to see when following the pandemic, money was free. Money was these asset managers and GPs, LP, they were trying to find deals. They had all this money trying to find deals, and maybe those deals were a little on the risky side. But so the the concerns are probably warranted, but do you think they're a little overdone?
I would generally characterize them as overdone. Yes, I think the idiosyncratic nature a lot of the issues that we've seen more recently is it doesn't speak to the broader trend in the economy. Certainly, and from a macro perspective, we think the economy is in a pretty healthy position. Corporate health is reasonably strong. So just again, take that from sort of first principles, just looking at what then that setup would be for private credit to operate in. Generally speaking, we think there's nice tailwinds behind it. Now, again, it's this idea of if you've got a ton of capital you're looking to deploy across the same sort of opportunity set that you've had over the last 5 to 10 years, broadly speaking, then again, you're probably stretching a little bit here and there. So there will be these episodic sort of areas of concern that pop up here and there. But again, broadly speaking, we don't think this is a huge point of concern for investors right now.
So it sounds investing in public equities. There's some cockroaches out there, right? There's some maybe bad investments, good investments, and you're going to have that in any type of market that you invest in, I'm assuming. Right.
Course.
So,
Yeah, that's right. And in this case too, you're looking to the managers that you're partnering with, that you're trusting your capital with, to be great stewards of that money, to make the right risk adjusted bet. And in some cases, that might mean taking a slightly lower return than they had in the past, because for them to stay within the same risk parameters, to keep the same downside protection, you may have to accept a little bit of a trade off there in terms of just the traditional finance math of risk and reward.
yeah, fantastic. And even though alternatives and private markets, there's a different way of looking at them and maybe different analytics at the end of the day, just like you said, it's like a public market in terms of what's that risk return trade off, right? And the risk that's involved and giving up maybe a little bit more return for something that's less risky. So, what do you think is causing these concerns? I mentioned, is it because money was free versus a pandemic and we're investing in things and chasing deals that really weren't so great? And now it's coming to light that maybe these deals they were, or these companies, private companies, they weren't as healthy as what we initially thought. Is that really what's the root of the concerns?
Yeah, I think there's some of that, right? Where you had deals done in a very different interest rate environment. If you go back 3, 4 years before the Fed started to hike in 2022, and you saw rates push up towards 5% on the short end of the curve, and you saw the long end reset as well, right? So if you had deals that were done in under that old regime, and you had sponsors that weren't perhaps as forward thinking about what that maturity would look like in 5 years, let's say, what's the interest rate environment going to look like, and will these companies be able to support a higher interest rate? That's where you've probably seen some indigestion, let's call it, within the private credit market, as you've had to see refinancings occur in a very different interest rate regime. I think that's part of it. And then again, I just come back to this idea of yet investors that rightly wanted higher yields in a very low interest rate environment post COVID. And then you saw this sort of transformational effect of evergreen products, and again, more of a fundraising army being deployed across the retail channel that's seen a lot of capital then flow into private credit, broadly speaking, and institutions as well. And again, I think that also it changes the dynamics around what deals you do. I think if you're a large platform, you're getting millions and millions of dollars, hundreds of millions perhaps of inflows in any given month that you have to put to work. Perhaps you're stretching a little bit at the margin on a couple deals here and there, and then that ultimately runs a slightly higher risk that you're going to see these idiosyncratic problems develop out of that type of dynamic. So I think it's a combination of a handful of things.
Yeah, that makes sense. That makes sense. I always wish it would just be easy and simple, but it never is. Never like truly black and white, is it? Do
No.
you think with the concerns, and maybe you mentioned like exits are scarce. There's not a ton of exits right now and concerns. Is it providing opportunities though for investors and advisors to maybe find some good deals and take advantage of it?
Sure. Yeah, I think on a couple different fronts. One would be if you've got fresh capital to put to work and you're looking at situations where there is a little bit of stress or distress. We don't do a ton in outright distressed investing, but I think if you are an opportunistic capital provider, a liquidity provider in an environment like this, and we can unpack what that means in particular different segments of the private markets, but you can command a premium for your capital because there are people that either need their refi on a loan. Even in the case of like real estate debt, for instance, you've got a big maturity wall coming up. You've got some real estate owners that may be underwater or having a difficult time refinancing their properties, right? There's just all different fact patterns whereby, again, a fresh provider of capital becomes is in the catbird seat right now in terms of thinking about how you want to deploy from a risk adjusted perspective. Maybe the other opportunity that I would highlight alongside that is I referenced it a little earlier is this sort of bifurcation of the market where I think you've got the upper end of the market that's seen so much capital. And again, these platforms that have done a phenomenal job of growing into this opportunity set. But I think on the lower end of the market, you still see a lot of fragmentation. You see a lot of inefficiency. So, whether you want to talk about lower middle market private equity, private credit firms that are more focused on the lower middle market, what we're seeing there is that you've got multiples valuations. Take private equity as an example in the middle market that still look much more reasonable than some of the upper kind of mega cap buyout segments. You're seeing terms for private credit that still look more like the old private credit days as opposed to converging with the broadly syndicated loan market. So for us, and we think, and we've got the luxury of not having to put out a massive amount of capital in any given year, any given quarter, where we can be a little more selective, play in those smaller, more fragmented, inefficient spaces like lower middle market private equity or lower middle market direct lending, and take advantage, again, of these higher returns and complexity premiums, illiquidity premiums that continue to be on offer.
Yeah, that makes sense. Great explanation there, Andrew. And talking about more opportunities, like you said, there are opportunities. If you have powder on the sideline, cash on the sideline, there's opportunities to put it to work during this time of uncertainty. Where do you think some of the opportunities are across private markets?
Yeah, I would highlight a couple different things. And we've been spending a lot of time recently kind of looking at our themes as we move into 2026 across private markets. One area, I don't need to talk about AI. Everybody knows about AI, not only from public markets, but also private markets, just dominating so much of the discussion.
Yeah.
But maybe it's not the first order effect of AI, but the second and third order effects, the derivative effects and the sort of diffusion of AI that it might touch on in the sense of you've got a wave of these lower middle market sort of private equity opportunities that really traditionally haven't done a whole lot in the way of implementation of technology and certainly not artificial intelligence, really diffusing that into more traditional segments like manufacturing, industrials, healthcare, business services, those sorts of things, where I think if you've got really strong sponsors in that segment of the market that are able to apply technology in a really thoughtful way and some of these novel technologies at that there's going to be a massive opportunity for private market investors to, again, don't necessarily think about all the buzzy tech Silicon Valley AI stuff, which is interesting in its own right. But I think this is a very different way of approaching the sort of application of AI and the advancements that we've seen within technology in more of the old economy, the traditional market. That would be one opportunity certainly that we're looking at. And then I think the other one would be, I think I would touch on secondaries, this idea where you've got companies that are just continuing to stay private for longer. So whether you want to talk about venture-backed companies, startups that are foregoing IPOs, it traditionally was something like 7-8 years. The average IPO was in terms of from the founding date until a company went public, right? Now it's more like 12, 13, 14 years. So you're seeing this extension of the life of private companies, particularly early stage companies that are in a high growth phase of their life cycle. If you're able to be a capital provider, go back to this idea of if you've got liquidity and fresh capital to put to work, and you're able to offer these investors liquidity in exchange for their position in some of these high growing startups, but they want to rebalance their portfolio, they need cash for whatever reason, it's a really interesting way to get access to that high growth segment of the market, oftentimes at a discount to whatever the last round was or intrinsic value. So we just think maybe those are two areas to highlight in terms of where we continue to see opportunity.
Why do you think that life cycle is a little bit longer? Is there something just hard to exit right now, or is there another reason for that life cycle to be extended to, say, 7 years?
Yeah, I think there are a few different factors you could point to on that. One would just be the sheer amount of capital formation that's occurred in private markets that allows it to happen, right? You've got bigger funds, you got more capital that's gone into venture capital or growth equity that can fund these businesses. Whereas if you go back 10, 15 years, there just wasn't enough money to continue to fund these companies. So I think that's a big shift. The other one's just a regulatory environment. I think it's much easier for companies, particularly if they're making changes or if they're innovating rapidly, if they're trying new products, those sorts of things, to do that in a private market setting versus a public market setting where they have to continue to disclose quarterly financials and they've got to answer to analysts all the time. There's just an element, I think, of the burden on companies being public that they prefer to stay private. And then the last piece is just, to your point, I think the exit environment, the lack of availability of the IPO avenue for exit over the last several years too, particularly 22 and 23, forced some of these companies to probably stay private a little bit longer than they would have otherwise. We think that that window starts to open back up and you'll see more IPO activity as we move into 26. But nonetheless, I think it's a whole host of factors that have played into these dynamics.
Yeah. And going back to your first example of good opportunities out there in AI and not necessarily AI, I'm really glad you didn't say data centers. I hear data centers all the time. So glad they're thinking outside those two easy answers, right? And those two easy segments, something digging a little bit deeper. So it's fantastic. You talked about earlier about bringing together retail investors, financial advisors with private markets and merging the two. So it's a hot topic right now. In addition, just to the headlines of private markets, it's a polarizing topic too, Andrew, of merging private markets with retail investors. There's risks out there. Are we ready for it? What do you think is the impact of having retail money flow into private investments? Like I said, adding private markets, alternatives to 401ks. There's a lot of elements here. How do you feel about it?
I think I would frame it up in the sense of where's that money going and what sort of opportunity set is it going to be addressing? And from our perspective, we think a lot of that ends up at the upper end of the market. We've talked about this a little bit already, but I think you've got platforms that are really designed to cater to the wealth channel now, and they're deploying a lot of resources towards capturing, whether it's 401k dollars, whether it's dollars through evergreen funds, structures that feel more familiar to a retail type investor. And ultimately, we think those platforms tend to chase a lot of the same sort of opportunities, which begets competition. So from our perspective, I think the wave of retail capital that comes in, and you've seen estimates over north of $500 billion to $1 trillion, maybe a couple trillion over the course of the next 10 years, really large quantums of capital that will be flowing into this space. We're just concerned that when you start to bring the supply of money significantly higher, the demand for deals is significantly higher, but the fundamental set, again, of deals that are available hasn't radically changed, then you're probably in for a period of disappointment from a forward-looking return perspective. To bring it full circle and answer your question here, I think from a retail investor perspective, I think it's great to get access to some of these faster growing, more interesting pockets of private markets, but it's asking yourself the question, what sort of return expectations do I really have here? Am I thinking about the historical 3 to 5% excess return over public markets? Am I comfortable if I only get 1% now because the fundamental supply demand dynamics have changed? And then in terms of illiquidity, right? If I'm locking up my money for some period of time, is that excess 1% or 2%, just making up a number here, is it worth me sacrificing the liquidity, the use of that cash, the opportunity cost of that cash potentially for that incremental rate of return relative to public markets? So there's just a lot of questions that we have around that particular segment of the market, again, where we think is going to see a disproportionate amount of the flows.
Yeah, that's a very good point. And don't really think about, again, that inflow of money chasing the same amount of deals, what impact that has. Obviously, competition probably is good, but does it again? Are you chasing deals that are very risky and maybe not appropriate for the retail side? So I feel as if it's still a wait and see. I like that and I completely agree with you too. I love that retail investors, we're gaining exposure. Retail investors get exposure to alternatives, right, in private markets. I think that's fantastic. It clearly helps portfolios. But like you said, you got to know what your expectations are getting into them and return risk before you start. really adding them to a portfolio. So great points there. You mentioned it, but what are some risks too of offering private investments to retail investors? Are there some other risks that maybe we're not thinking of? Obviously, liquidity risk.
Yeah, liquidity is got to be where you start here, and just understanding not only the explicit risk around I can't get my money out of this investment, but then it's this implicit idea of if I'm locking up my money here, I'm foregoing opportunities over there, whether that's public markets or other investments. So I give up the flexibility, the ability to adjust my portfolio on the fly in a more quick, nimble fashion. So I think it's understanding that. And then a lot of what we concern ourselves with is the math around the compensation for that illiquidity. And I think that's an exercise where if you haven't gone through that and started to think through and parse through the illiquidity premium that you're underwriting in whatever investment you're going into, it's easy to get caught up in this idea of this is exciting, this is different, this is new, I want to participate, relative to just actually going and sitting down from first principles and saying, what do I anticipate the return on this investment being? When I stress this investment, run a variety of different scenarios, how long does it take me to get my money back if I want to liquidate this thing? What are the terms around that? Am I being haircut in some form or fashion? So I think it's just all the complexities that come along with these structures. And a lot of that does revolve around liquidity that we would highlight as potential risks. And just for advisors and for clients, investors to be really eyes wide open and thoughtful on the front end as they deploy into private markets.
Yeah, that's a good point. Yes, I might want a higher risk premium or a higher premium for illiquid, not being liquid than you. So I guess for a financial advisor, all their clients are different. You got to understand like what type of premium do they want for an investment not being liquid. I might want a higher premium or a lower premium because I've got longer time frame. So it always goes back to it's like a broken record, understanding your client's risk profile, investment objectives, time frame, and all that good stuff. For a financial advisor, what type of questions or considerations? Obviously, we talked about liquidity. Should financial advisors ask when conducting due diligence on managers, private managers, and the different offerings?
Yeah, I think just understanding the structure, understanding the terms is really important because there are going to be many more structural nuances around these private market vehicles, in most cases relative to any sort of public market equivalent. So just really getting your head around what all that looks like and then running it through different stress tests and scenario testing, those sorts of things. I think that's an important discipline as you think about underwriting private markets investments. Then you start to get into things like, sourcing becomes a really important dynamic within private markets that you don't necessarily think about in public markets, right? You can transact Apple stock, you can transact Palantir stock, whatever you want, right? But from a private market perspective, it's how do you get access to the very best deals? How do you have some sort of sourcing engine set up to be able to not only see everything, but then when you want to choose something to go after, what's your right to win? How are you going to get access to that private company, to that venture capital backed company, to that private credit instrument that you think is especially attractive, right? So we spend a ton of time on that and understanding that element of a process for a sponsor, a GP, those sorts of things. And then I think value creation is another important piece for us where you can have more of a hands-on impact on your portfolio companies, your portfolio loans, if you're a private credit manager, your properties, if you're a real estate manager. What sort of operational value add do you bring to the table that separates you? And some of this all kind of flows back to the sourcing element and your right to win. How can you separate yourself from your competition? And ideally, we're looking for managers that can truly add operational value to their underlying portfolio companies or properties, those sorts of things, right? They've got some sort of differentiation in what they bring to the table relative to just being able to write a check. I'd probably highlight those three things, certainly exits and their ability to function within the broader capital market ecosystem and pull different levers to create value on the back end, and liquidity for investors is another important consideration. But I think those first three, structure, sourcing, value add, are probably where we spend the most of our time in terms of underwriting.
Yeah, fantastic. And now that money is more expensive and there's a value to it, probably makes that due diligence process even more important and focusing on doing a comprehensive due diligence. So,
Yeah,
what
it's always important for us, right? And just I would say diligence, that's an unwavering commitment to really understanding these private market funds, opportunities, structures, those sort of things. Because again, you in many cases are committing that capital for several years. So you're getting married, right? You want to be pretty certain on the front end that you've got a good counterparty here that is going to be a great steward of your capital over that period of time. Pretty high bar in terms of the diligence.
Yeah, for sure. Lastly, you mentioned earlier kind of some trends for 2026. What is your outlook for private markets in 2026? Putting you on the spot here, Andrew, get that crystal ball out.
Yeah, I think from our perspective, big picture, macro, we continue to see an economy that's in pretty good shape. Unemployment has ticked up a hair, but in general, we think that the economy, broadly speaking, is in good shape. So, with that as a backdrop, then if you overlay that on private markets, we continue to see a lot of opportunity. The AI thing, it probably is a little bit overwrought in terms of a narrative, but it's also incredibly exciting. And when you talk to folks in VC and growth equity, the rate of growth of these companies surpasses anything they've seen historically. I've seen estimates and heard folks recently talk about 3 to 4 times kind of the SaaS boom, software, cloud adoption, that sort of thing. The trajectory of these companies going from 0 to 100 million in revenue is just mind boggling. There are real results that are happening there and opportunities to continue to back transformational businesses that will probably be the winners for years to come here. So we think we're right in the heart of that. 2026 will be a continuation of what we've seen from 2025 as well. And then it's some of these other themes that I mentioned in terms of kind of the proliferation of AI throughout maybe legacy segments of the economy. We think there's a ton of interesting things happening there and that will continue to happen over the coming quarters and years. So positioning for that is an exciting opportunity ahead of us, we think. And then maybe the last one, again, is just this idea of liquidity. So 2026, we think probably brings a better market for exits, for M&A, for IPO activity. And then there's a continued, though, thinking that companies will continue to stay private for longer. In that case, we want to be there to support these generational companies that are doing phenomenally well, that have just chosen not to go public for whatever reason. Or we want to be there to give exit liquidity to folks that don't want to continue on that journey in private markets. And we can take advantage of the fact that we're a liquidity provider in an environment where they're looking for that capital, right? They're looking for cash to redeploy. Those are, if I try to put it in broad terms, those would be the big themes that we're looking at as we move into next year.
Yeah, fantastic. That makes sense. And you talked about that explosive growth within AI. To me, it's just how quickly it's moved forward. It seems like we've been talking about AI for years, right? Oh, when AI comes, well, it came and it came like a box of like it just came quick, and it's amazing how fast it's advanced in really a year since really we got exposure to chat GPT and the other AI tools, and now it's just full force ahead. It's amazing how quickly it's advanced.
Yeah, I would say to that point, this is the worst it's ever going to be. Meaning, these AI applications, the AI infrastructure, everything that's being built today is only going to get better. And I
Yeah.
think we're still at such an early stage of adoption in, again, old economy type businesses, old economy segments of the economy, the market as well, that it just presents such a compelling opportunity to think about who are the right players to be able to implement this stuff in a really thoughtful way to drive productivity, drive efficiency, to create a ton of value going forward. So those are some of the things that we're just super excited about as well.
Yeah, good point. It's a huge opportunity for whether people are concerned about losing their job. I think it's an opportunity for investors, a lot of opportunities out there. Andrew, thank you so much for coming on the show again. It's always such a fun conversation and honor to have you on. I always learn a lot. It's always been really fun. Can you please tell us a little bit more about yourself and Crescent Grove Advisors, or where our audience can get more information about Crescent Grove Advisors?
Yeah, and thanks again to you for having me on. This is a great discussion. If you go to our website, www.crescentgroveadvisors.com, has a bunch of more information about the firm, our team, the services we provide. Then I'd recommend you follow us on LinkedIn, follow me on LinkedIn as well. We're pretty active in terms of posting and try to put out our thoughts on the market, private markets, public markets, the economy, et cetera, pretty actively. We encourage everybody to go there and check it out.
Yeah, I encourage the listeners to also. I follow you guys. Go to your website. A lot of great content helps me get a better grasp of what's going on in the environment. So great stuff there, Andrew. And Andrew, thank you again, and thank you so much for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to like and subscribe to those channels and give us a follow on LinkedIn. Thank you and have a great rest of your week.